It's been a year since Motilal Oswal AMC started launching equity funds. How has your journey been since then?
Hi, good morning to everybody. We think we've had a fairly good experience all round, both in terms of the way we have conducted the portfolio as well as the environment and the market conditions which have surrounded the portfolio during the period of the last 1 year since the launch of the fund. Uh, from our point of view, we have been able to ensure that we focus and remain committed to the mandate of the fund the way it had been set out at the time when we had launched the scheme. And to that extent, we have, if you look at the characteristics of the portfolio, the way we have managed the portfolio in terms of its things like churn levels, and in terms of our basic philosophy of trying to ensure that we buy quality companies for the long term. That objective and that focus has been relentlessly adhered to in the space of the last 12 months. Of course, as a result of which we have seen uh, performance variations during the course of the year, both with respect to the benchmark as well as with respect to the peer group. But that has not influenced our style of an approach towards the fund, the way we had set it out to be at the time that we launched. So we have stuck to our basic philosophy. We have maintained it as a core, high quality, focused portfolio. It today comprises of about 20 odd stocks. It never crossed 20 stocks ever in the space of the last 12 months. We've had relatively low churn levels. We've on an aggregate basis, I think we have probably exited about 4 to 5 stocks out of the 20 stocks in the course of the last 1 year. And some of them have actually, in fact, been as a result of certain regulatory changes also. On a net basis, I think we would have at best moved out of 3 or 4 positions during the course of the year. So that's again in line with our stated objective. And so all in all, I think it's been a good way of illustrating that we are not, when we say buy right and sit tight, we are not just making it making it out to be a slogan. That is something we firmly believe in, and we are ensuring that it reflects itself in the way we conduct our portfolios too.
Motilal Oswal is known to be a fund house whose stated mantra in all the equity funds is buy right, sit tight. Can you elaborate on this strategy?
Essentially, buy right, sit tight is basically the extension of the quality, growth, longevity, or the QGL philosophy that we have espoused all throughout across not just F25 but across all our mutual fund products as well as our PMS products under the AMC umbrella. So when we are saying buy right, it is basically the word right actually focuses on buying the right quality stocks. In our view, right essentially is the manifestation of the whole quality angle out of the QGL philosophy in that word. So basically, when we are talking about buy right, it is essentially about buying companies that have those quality characteristics that we desire. And as we have discussed on many occasions, basically for us, the quality is more to do with the nature of the business. We want to buy businesses which have those economic moats and those enduring competitive advantages which can last over a longer period of time. And essentially that's what right is all about. And sit tight is again the whole thing about ensuring, again the other part of our philosophy, which is basically approach portfolios with in a focused and disciplined manner and invest for the long term. If you buy the right quality companies, and if you ensure that you are invested for a longer horizon rather than trading or making shorter term calls on these stocks, then the kind of compounding benefit that you get out of these companies is simply phenomenal, and that is what actually gives you that necessary outperformance or alpha with respect to the market. So in a way, buy right, sit tight in a different way encapsulates or captures the QGL basic QGL philosophy for us.
When there is a lot of positive sentiment in the market over the election results, How do you use the buy right and sit tight philosophy to convince investors to hold on to their investments and not to book profits?
So that it works very well for us, especially in this kind of an environment where now actually you are probably from an environment perspective, from an economic growth perspective, outlook for the next 3-4 years looks like being significantly enhanced. We would think that this buy right sit tight philosophy becomes more and more appropriate and relevant, because it is now going to be the time for the quality companies which have done a lot of work in the past few years, past 5-6 years, in terms of investing in the right places, investing in the right product categories and the right markets. They will be the largest beneficiaries of the possible recovery in economic growth and maybe an economic boom as well as we go into the next 3-4 years time. So if this will be the time when again good solid franchises which have got large market shares and which have got the past experience will be able to assert themselves and take themselves in terms of growth to the next level. So if you sit tight with these kind of companies, with the quality companies, then your ability to compound your growth is the next 5 years actually would give you another opportunity to compound your appreciation, compound your investments by a significant margin, because that is how the wealth creation actually happens. And these are the companies actually will be the most preferred. What has also happened is that in the last few years, because many of the smaller companies have fallen by the wayside, given that they did not have the necessary strength in terms of balance sheet, etc., to hold out, there has been a lot of consolidation in various industries. So the larger the companies have become, they will become even bigger beneficiaries of the next boom. So clearly we think that it ties up very well with our philosophy to make for investors to benefit out of this buy right sit tight philosophy now in a boom time. In a boom time, it is very easy to get carried away, and that's exactly the time when low quality companies actually start making an appearance into your portfolio. And this is exactly the time where you have to avoid those pitfalls which have occurred in the past and ensure that you keep sticking to quality stocks, keep buying the right stocks and buying the right companies for longer durations, which will allow you to get the return over the next bull market, as well as probably conserve your capital if at all you see the next bear market as well going forward.
You manage all the three funds from the equity stable, that is most focused 25 fund, most focused mid cap 30 fund and most focused multi cap 35 fund. Could you differentiate between the three schemes on the basis of their investment strategies?
The Focus 25 fund, which is our flagship fund and was launched about 12 months ago, essentially has been conceptualized as a large cap offering, and is predominantly by its very mandate also invests in large cap companies. The Focus 25 basically is restricted to an investment universe of the top 150 companies listed on the exchange by market cap, and of which the top 100 companies necessarily need to comprise at least 75% of the portfolio. So it is predominantly, therefore by definition, operates in a range of minimum market cap starting 7,000 crores and going upwards. The Focus 30 fund on the other hand is our mid-cap offering, and predominantly entirely mid-cap offering. It operates in a investment universe starting from the 101st company listed on the market cap on the exchange on the basis of market cap, going down all the way to a minimum market cap of around 2,000 crores as we stand today. So it has a wider investment universe, but it essentially operates in a mid cap in a market cap range of between 2,000 to about 11,000 crores. So clearly, to that extent, it is a significantly mid cap oriented fund. Today, even though there is a certain investment universe overlap between F25 and 30 and F30, we as of now do not own any common stocks between F25 and F30, so their positioning is very, very distinct. Focus 25 is meant to be a moderate growth, moderate risk portfolio. We would look forward to a 15-20% kind of CAGR returns in this portfolio over a 3 to 5 year perspective. The Focus 30 on the other hand, given that it is basically looking at companies which are in its evolution phase and are in the emergence phase of their corporate journey, would probably illustrate higher growth levels, and to that extent we expect that portfolio, the returns out of that portfolio could be in the vicinity of between 20 and 25% CAGR in the next 3 to 5 years duration. The last and most recent offering, which is the Focus 35 multi-cap product, as the name suggests, is supposed to be a cap neutral fund. It is distinct in the sense that at least compared to the F25 and 30 and F30, it has a completely flexible universe. It doesn't have any restrictions in terms of its operating universe. It is basically meant to rationally allocate portfolio weights between the large and the mid cap constituents based on the fund manager's assessment of the performance of large cap companies and mid cap companies. So in a way, instead of leaving the investors with the challenge of making a decision regarding how much to invest in large caps and mid caps, this decision moves on to the expert hands of the fund manager to be able to decide as to when the allocation within the fund should, if necessary, be changed towards a large cap bias or towards a mid cap bias based on his assessment. So that's the one important differentiator of the F35. In addition to which, the Focus 35 F35 multi-cap fund also has the flexibility to invest in foreign securities, which would again also fall under our overall QGL framework and buy right sit tight philosophy. So that is the additional feature of that fund, which over a more longer period of time can be exploited by the fund manager to the benefit of the investors.
Okay. In the current scenario, how much of a surplus should an investor allocate into most focus 25 fund and most focus 30 fund?
Well, I think from our point of view, like as I mentioned earlier, we have basically ensured that we don't proliferate more products. For us, we think that a large cap and a mid cap strategy are enough to meet the expectations of most investor classes and investor types. Those who prefer a moderate risk and a medium growth kind of investment objective should look at F25 as an allocation. Those who are in a position to live with a slightly higher level of risk, which also at our end we try to minimize by ensuring quality, should look at most focused mid-cap 30 as a pure specialized mid-cap fund. If one were to just narrow down the universe to these two schemes from Motilal Oswal, then I think in the current evolving scenario, the way we see things, the economy and the markets panning out over the next 4 to 5 years, I think equal allocation to both these schemes would be the best way to make a beginning. As we go along, depending upon how the markets behave in the medium term, let's say over the next 12 to 18 months, one can always try and reallocate or move around the allocations and fine-tune that. But a good starting point would clearly be a very simple 50-50 allocation between these two schemes.
Coming to your personal portfolio, do you follow the buy and hold strategy or do you book profits on a regular basis?
Well, my experience till now has been that my investments essentially happen to be to a large degree in the mutual fund schemes that I manage. Secondly, we also, given the nature of our work, there are certain regulatory compulsions that we have to follow, which unfortunately inhibits us very significantly from investing in individual stocks. So basically, my portfolio largely comprises of the mutual fund scheme investments, and more out of that into the schemes that we have launched over the last some time. And of course, given that it's a buy and hold strategy by itself on the underlying portfolio, therefore my strategy also invariably becomes a buy and hold by definition. In addition to which, I have a few stocks which are have been my core holdings for a very long period of time. Of course, they've been also a result of some of the stock options which I have had in the past, and but the good part has been that I have been able to practice buy right sit tight on that as well, and to that extent it has worked very well for me. So I would think that makes a lot of sense. Not just it has made a lot of it has brought in a lot of benefits to me, and especially over the last 5-6 years when the market has probably been very difficult and challenging, and I would recommend the same to all investors at large as well.
Thank you so much, sir.
Thanks.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.